All right, let's talk about one of the scariest words in all of economics, deflation. Now, on the surface, the idea of prices falling sounds amazing, right? But we're about to unpack why it's actually an economic nightmare waiting to happen.
So, here's the big puzzle. Who doesn't love a good sale? Your groceries are cheaper, gas costs less, that new phone you've been eyeing is on discount. It feels like a win. So, why on earth do the people in charge of the economy, central bankers, break into a cold sweat at the very thought of prices falling across the board?
Well, it's because what looks like a dream for you, the individual shopper, can turn into a total nightmare for the economy as a whole. I mean, sure, it's great that things are cheaper, but that won't matter much if your paycheck gets cut. Or worse, you lose your job entirely. And that mortgage or student loan you have, the real weight of that debt just gets heavier and heavier.
Okay, so to really get our heads around this, we need to dig into what's known as the price paradox. And that starts with figuring out what deflation actually is. First things first, deflation is not just a weekend sale at your favorite store. No, it's a deep, persistent, economy-wide drop in prices. And it's super important not to mix it up with disinflation. Think of it this way. If inflation is the speed of your car, disinflation is just taking your foot off the gas a bit. You're still moving forward, just slower. Deflation, that's slamming the car into reverse. But here's where it gets really interesting. There's a huge twist. Not all deflation is the same. It turns out the reason why prices are falling is what separates a healthy, booming economy from a truly dangerous downward spiral.
So on one hand, you have good deflation. Just think about the price of a flat-screen TV or a laptop over the last 2 decades. Technology gets way better, production gets more efficient, and so the products themselves get better and cheaper. That's a sign of progress. It's supply-driven, and it's something to celebrate.
And then there's the bad kind. This is the one that keeps economists up at night. This is when prices fall because demand just collapses. People are worried, so they stop spending, businesses stop investing. Prices aren't falling because we're getting better at making stuff. They're falling because nobody's buying it. It's a symptom of a very, very sick economy.
And when you put them side by side, the difference is just night and day. With good, supply-driven deflation, the economy is actually growing. But with bad, demand-driven deflation, the economy shrinks, companies lose money, and people lose their jobs. Getting this distinction is absolutely key to understanding the whole issue.
So let's zoom in on that nasty, bad deflation, because its most dangerous feature is how it interacts with debt. Together, they can kick off this vicious, self-feeding loop that's incredibly hard to escape. An economist named Irving Fisher figured this out way back during the Great Depression. Here's how that spiral works. It all starts with too much debt. Then some kind of shock happens, a bubble bursts, and everyone scrambles to sell assets to pay back what they owe. This fire sale of assets makes prices tank. But, and this is the killer part, while the value of your house or your stocks is plummeting, the amount of your mortgage stays exactly the same. Your net worth gets wiped out, businesses go under, they lay people off, and demand dries up even more, which just starts the whole horrible cycle all over again. Fisher nailed this terrifying paradox with one sentence. Think about it. In a deflationary world, every dollar you pay back is worth more than the dollar you borrowed. So the harder you work to pay off your debt, the heavier the remaining debt becomes in real terms. It's like you're trying to run up an escalator that's going down faster and faster. So you might be asking, why is this spiral so hard to stop? Can't the government just, fix it? Well, that's the scary part. Once this thing really gets going, all the usual tools that policymakers use to manage the economy become basically useless. They get caught in what's called a liquidity trap. See, normally when an economy is struggling, the central bank just cuts interest rates to make it cheaper to borrow and spend. But what do you do when interest rates are already at zero? Your main weapon is gone. People are so freaked out about the future that they just hoard cash, waiting for prices to fall even further before they buy anything. This little bit of math shows you exactly why. Let's say the bank isn't charging you any interest, 0%. But if overall prices are falling by 3%, the real cost to borrow is actually positive 3%. Why? Because you have to pay back the loan with dollars that are more valuable than the ones you got in the first place. So why on earth would you borrow to invest in a business? And if that wasn't bad enough, there's another trap waiting: sticky wages. See, the prices of goods can drop pretty fast, but wages? Not so much. Companies find it really hard to just cut everyone's salary by 5%. So as the prices of what they sell go down, but their labor costs stay the same, their profits get squeezed into nothing. Their only move? Layoffs. which of course just throws more gasoline on the recessionary fire.
Now look, this isn't just some dusty old theory from a textbook. We might be watching a massive, real-world case study of these exact forces playing out right now in China. For decades, the engine of China's incredible growth was its real estate market. I mean, at its peak, it made up a staggering 30% of their entire economy. It was this enormous source of wealth for millions of families and a huge driver of economic activity. But that engine has completely seized up. The property market has been in a steep decline, and that creates what economists call a negative wealth effect. Basically, as the value of their biggest asset, their home, falls, millions of people feel poorer. And what do you do when you feel poorer? You stop spending money. That puts massive downward pressure on prices for everything.
And you can see that pressure building in the data. Look at this. Consumer prices are totally flat. Zero inflation. But check out producer prices. That's what factories are charging for their goods. They're deep in deflationary territory. This right here is a classic flashing red warning sign. This is exactly why you're hearing so many people draw comparisons to Japan's infamous lost decades, which also started with a huge property bubble bursting. Now, there are some really important differences too. China's problem seems to be less about a total collapse in demand and more about just insane levels of industrial overcapacity. They just built too much of everything. The billion-dollar question now is whether they can somehow manage to avoid Japan's fate.
Okay, let's step back from the numbers for a second, because the final piece of this puzzle is maybe the most important of all. The real ultimate cost of long-term deflation isn't just economic, it's societal. History gives us an absolutely chilling warning here. The Great Depression in the 1930s was the worst deflationary period the world has ever seen. And just look at this timeline from Germany during those years. As the economic pain got deeper and more hopeless, you see this terrifying explosion in support for extremist political parties. It's a stark reminder that severe, persistent economic hardship creates a fertile breeding ground for radicalism.
And even if things don't go to that dark place, a stagnant, deflationary economy just eats away at the fabric of society. It destroys social mobility. It makes it almost impossible for kids to have a better life than their parents. When the economic pie is shrinking instead of growing, the fight for a slice gets ugly. Inequality skyrockets, and society starts to come apart at the seams.
Which brings us right to the final fundamental question. You know how central banks always say they aim for about 2% inflation? It's not because they love it when prices go up. It's because they are absolutely terrified of the alternative. So we're left with this dilemma. Is a little bit of steady inflation the necessary, maybe even unavoidable price we have to pay to keep our economies growing and our societies stable? That's the core trade-off at the very heart of modern economics.